Okay, so let's start section 3.6 now, which is free cash flow to firm and free cash flow to equity on a use of free cash flow basis. I don't think this is overly testable, but the general idea is this. Everything that what have we done so far? We've tried to figure out estimates, so we've tried to figure out free cash flow to firm and free cash flow to equity. And we have done that based on sources of cash. Okay, so what are sources? So, for example, net income, and then made adjustments to net income. So all that is based on sources of cash. It is also conceivable that once we have come up with free cash flow to firm and free cash flow to equity based on sources of cash, just as a check, we also look at analysis based on uses of free cash flow. Conceptually, and since there are no examples on this, that is the cue that it's not as significant. Just from a curriculum perspective, you can imagine if there is a topic and they've given 10 examples, then that's important. If there is a topic on which there are no examples, relatively less important. But still, conceptually, I think this is important to understand. What are the uses of free cash flow, Mubin? So what do we do with the free cash flow? Yeah, actually, the free cash flow then goes back to the providers of capital. Right? So you've already invested. So free cash flow is the money available after working capital investment, and so you remember those terms, the fixed capital investment, working capital investment, etc. So after the investments, the money that's left, what do you do with that? You pay dividends. So you pay back the shareholders, you pay back the bondholders. So you basically look at the projected uses of cash into the future and see if they line up with your estimates from the source of cash example. So that's the core point. Okay, now how do you calculate free cash flow to firm and free cash flow to equity? There are several ways of doing this, and to be honest, this is more art and less science. What we've done so far is the science part, just the mechanics of how to come up with free cash flows given all the numbers. But what's the hardest part of the job of a financial analyst? It's to actually come up with the proper forecasts. Okay, so it's once you have those forecasts, everything else is mechanical. Mostly on the exam, you are being tested on the mechanical stuff, okay, because you need to know that. But the forecasting stuff is tough. What are some techniques used by analysts? One simplest technique is to use this constant growth assumption. So apply some constant growth rate to the current level of your free cash flow to firm or free cash flow to equity. The simplest basis is using historical growth rates. So look at historical growth rates and just apply those. You can also look at the various components of free cash flows and apply growth rates to those components. What are the sorts of assumptions you need to make? So investments in fixed assets and working capital bear a strong relationship to increase in sales. So you can say that if my sales are increasing from 100 to 200, do you think there will be an increase in working capital investment? There needs to be. Do you think fixed capital needs to go up? Probably. So a very simplistic assumption is that your working capital investment and fixed capital investment, which are needed to come up with your free cash flows, you make assumptions based on sales growth numbers. And very often most forecasting is based on first forecasting the sales and then working down from that. Okay, but what else do you need? If you are coming up with your free cash flow to equity, do you think you need to make assumptions about capital structure? Yeah, what's the simplest assumption to make unless you know any better? That the capital structure will remain the same. Okay, some basic input, forecast sales growth and operating margins. That's important. Estimate of fixed capital investment and working capital estimate as a percentage of sales that we've talked about. Estimate of debt ratio. This is an important concept that we'll delve into. Debt ratio stands for if you are investing $100 more, what percentage of that is coming from debt? Why do you think it's important to know that? Because when you are coming up with your free cash flow to equity, you need to know what your net borrowing is, you need to know what your interest payments are, but the biggest part is figuring out what your borrowing needs to be. Okay, so now let's look at this example. I want you to read this. This is example 9 in the curriculum. Okay, so the key points here are to figure out your investment in fixed capital. So how do you think we'll figure out our investment in fixed capital? The point is this, and there are some tricky points over here. Let me just go through this with you so you can understand. I think this is a high probability item on the exam. So company's sales for 2007 were she can see that the company's sales for 2007 were 3,000 million. She assumes that the sales grew by 300 million from 2006 to 2010. So sales went up by 10%. So Espinosa expects Pitts Corporation sales to increase by 10% a year. So she's just making a simplistic assumption. Fairly stable company, so she expects it to maintain its historical EBIT margin and proportion of incremental investment in fixed and working capital. So if the EBIT for 2007 is 500 million, its EBIT margin is 16.67% and its tax rate is this. Why do you think she's doing this? So if she's estimating EBIT margin, she's assuming that in the future the EBIT margin is the same. So that means that if she can project sales, she automatically has her operating profits. Okay, so that's a good start. Next, she notices that the statement, so they've announced purchase of fixed assets of 400 million and depreciation of 300 million. So what is happening here? The additional amount of money spent on fixed assets is 400 minus the depreciation is 300. So what she is saying is that the money spent on investment as a percentage of sales is 33%. Okay, the tricky part here is if depreciation is a non-cash expense, why are we subtracting it? Okay, because from what I said earlier, we were not subtracting depreciation. Now I am, or not I am, but the curriculum is subtracting depreciation. Okay, I'll make a couple of comments on this. The explanation given for why depreciation is subtracted is that we are making a very rough assumption that depreciation expense is a measure of how much money is needed to keep your equipment maintained and at the same level that it was at the start of the year. So it's a very huge and very rough approximation. So we are saying that at least our equipment so far, to maintain that, we need to cover that, we need to pay for that. That is considered a operating expense that's already dealt with. So if we are talking about fixed capital investment, then we are just subtracting that out. Whether or not that made sense, just take it as a given. If in a problem you are not given the depreciation expense, then just assume it is small enough that it's not been given and ignore it, because there'll be problems later where you are given the capital expenditure and there's no mention of depreciation. So there obviously you don't need to subtract anything. But if you are given the depreciation expense in a situation like this, then you subtract it. So your capital expense is 33%. What is the interpretation here? The interpretation is that if sales go up by 100, then your fixed capital investment will be 33. Okay, so why is this important? Because as you are projecting your free cash flows, to project free cash flows, you need to also know your fixed capital investment, and this is what is helping you get that. What about working capital? They've told you that you are spending 45K on working capital, so just take that as 15% of increase in sales. So the interpretation here is for every $100 more of sales, you need to invest $15 more in working capital. Okay, so that's what I just said. So for every $100 increase in sales, the company needs to invest 33 in new equipment, in addition to the replacement of depreciable equipment, etc., and 15 in working capital. So now, how do you come up with a free cash flow to firm? If in 2008, or actually whatever, so in 2008, what did we assume about sales? They'll be up by 10%. So that's this. Where do we come up with EBIT? Based on the assumed EBIT margin of 16.67. So that's where this number comes from. So that's the EBIT minus the tax rate. And then incremental fixed capital investment, incremental working capital investment, and we come up with our free cash flow. The regular depreciation is dealt with in your EBIT margins. This is not to be confused with the formulas given earlier. Now we are projecting free cash flow in the future using one simplistic method. So this is something different we are talking about relative to earlier formulas. What are we talking about now? We are talking about forecasting free cash flow, and we are using perhaps the simplest possible forecasting model. What is this? Well, almost the simplest possible. So what are we saying here? We are making an assumption that sales will go up, so the top line will go up by 10%. Okay, so that's our assumption about sales. Okay, if we've also made an assumption that our operating profit is 16.6% of sales, so then our operating profit is this. We are making an assumption about the tax rate, which might be fairly stable. So EBIT into 1 minus T is 330. Then we are making an assumption about our incremental fixed, so our investment in fixed capital. What's the assumption? The assumption is that the investment in fixed capital is 33% of the incremental sales. If the incremental sales is 300, then the investment in fixed capital is 100, and we are making an assumption that 15% of sales increase goes into working capital, so that's this. So this is just one. Okay, so anyway, so that's fairly straightforward. Okay, now the next segment is to forecast. So now let's say next you are asked to calculate the free cash flow to equity. So how will you do that, Tosif? Free cash flow to equity. It's not just interest. So if we know our free cash flow to firm, so we know our free cash flow to firm, how do we calculate our free cash flow to equity? Okay, so the simplest thing to do actually in this model is to add net borrowing. Okay, so that's what we are doing here. Now, how do we figure out the net borrowing? To figure out net borrowing, we need to know what the debt ratio is. So again, this is a simplification, and you need to know the simplification because the curriculum makes a big deal of it. Does this make sense? That your net borrowing, so you are making your investment. Okay, so the net borrowing will be the debt ratio. Let's say that the debt ratio, real simplistically, is 50%. What does that mean? Exactly. So very straight, debt ratio means that if you are raising 100, from that 100 you need 50 out of debt. So how much money did we say we need for fixed capital investment in this simplistic formula? The money was so fixed capital investment minus depreciation into, this was the formula earlier. But as I said, if in the data there is, they are not explicitly bringing out depreciation, they are just netting it out. So what do we do over here? The incremental fixed capital is 100. The incremental working capital is 45. So how much is the incremental investment? 145. So the net borrowing is simply 50% of that. So your free cash flow to equity is 1. So all you've done is added the number. Okay. Now moving on. What are some other issues in, so section 3.8, some other issues in free cash flow analysis? Okay. Because the CFO figure from the statement of cash flows may be contaminated by cash flows arising from financing or investing activities, when an analyst uses CFO in valuation, ideally he should remove such contaminations. The resulting adjusted CFO is then the starting point for free cash flow calculations. Okay, so here is my interpretation of this. All we are saying is, if you recall, in level 1, you had a reading called Accounting Shenanigans in the Cash Flow Statement. And one of the biggest issues there was manipulation of CFO. Do you remember that? So sometimes something that should not be CFO is placed in CFO, either because of strange accounting rules or because of the company trying to manage and show a better CFO than should be. But all this point here, and I don't think we need to get into too much detail as evidenced by the sort of examples they've given, but you need to recognize that the CFO might not be very clean. So simplistically, what does the analyst need to do? Need to clean up the CFO. If some things should be in investing, then they should be removed from CFO. And they give a really simplistic example, which I think from an exam perspective is possible you get something like this. All they are saying is a recent job applicant said something like this: I don't like the definition of free cash flow to equity and free cash flow to firm because they are unnecessarily complicated and confusing. So you might think the same thing but never say it. Okay. And then he says the best measure of free cash flow to equity are the funds available to pay dividends, i.e. simply the net income. Do you think this guy will get a job? No. He'll not. And then in the explanation, it is stated that he is wrong, and all they've told you that free cash flow to, so they've given, do you think this sounds like free cash flow to firm or free cash flow to equity? Okay, so since we are dealing with net borrowing, so you are supposed to tell that job applicant, after telling him that he's not going to get this job, that the problem with just using net income is that it doesn't account for non-cash charges, it doesn't account for the cash spent in fixed capital, working capital, it doesn't account for net borrowing. So as in, you would like to say to him that he's fired, but he was never hired in the first place. Okay, so did you know this already? Yeah, you should have, right? So that, and what about free cash flow to firm? The job applicant says that simply use EBITDA, which is actually a proxy that is used quite often. And it is okay to use it as long as you know that it's an approximation. And the better measure of free cash flow to firm, what's the issue with using EBITDA as a proxy for free cash flow to firm? It doesn't account for the depreciation tax shield, and it doesn't look at the investments in working capital and fixed capital. So those are the quick answers, and these are quite likely to be tested in some form. So, and the reason this is likely to be tested is, analysts here will tell you that a lot of valuation and estimates are done based on EBITDA, which is okay because all this is an approximation, but as long as you know what are the limitations. Okay. So now earlier I made a mistake on preferred stock and was fortunately corrected. Let's just take an example of free cash flow valuation with preferred stock. So there's a company that has preferred stock in its capital structure. If preferred stock dividends have been paid and net income is income available to common shareholders, then, so if net income is defined after the preferred dividend, which it might or might not be, then what do we do if we are calculating free cash flow to firm? Then we should add back the preferred dividend. If the net income is defined before preferred dividends are paid out, then obviously we don't need to add back. So how do you distinguish between the two? Sometimes you are told here is the income available to common shareholders. So if you are given that statement, what does that say about preferred dividend? That it has been subtracted. So you need to be careful about the terminology. Okay, we are close to nearly at the end of this reading. So international applications of the single stage model. All this is saying is, this is just giving you one simple way of valuing a company that is, say, in an emerging market or in a developing country such as Argentina in this example. Without getting hung up in the details, how do you do this? In countries, in emerging markets, typically a big issue is inflation. So when inflation is an issue, then you should use real numbers as opposed to nominal growth rates. So using the Gordon growth model, I'm just going to explain what this model says. The value of this company is the free cash flow to equity. This is the value of equity. It's the free cash flow to equity at time 0. So you estimate that, or you calculate that in a way that we've already talked about. And then you look at what's the real growth rate. So that's the growth rate. If it's selling units, widgets, you look at the growth rate of how many widgets it's selling as opposed to a currency number, minus the required rate of return in real terms, minus the growth in real terms. So this is just the Gordon growth model. The question now is, how do you come up with this real rate? And the simple model suggested in this example is that you come up with a required real return for the country, in this case Argentina, whatever that number might be. For Argentina, the required real return, say, is 7.3%. And then you make an industry adjustment. So if you are investing in an industry that is more riskier than average, what do? You add an adjustment. Then you make a size adjustment. So just to check your understanding and relating this back to certain models that you have studied earlier, if we are making a size adjustment of minus 0.33, do you think this is a large company or a small company? This is a large company, so it's relatively safer, so you reduce. And then leverage adjustment. So is this high leverage, low leverage company? So it's a relatively lower leverage, so it is safer, so you subtract. Now, there is no way that you will be asked to calculate these components, but it is possible you are given the components and then you should know what to add, what to subtract. So what does 7.65 represent? It's the real discount rate for this particular company. And then you plug in the numbers and you come up with your value. So nothing too difficult. Okay, another technique that is necessary for analysts to know is sensitivity analysis. So just because you've come up with a valuation, does that mean you are right? Not necessarily, because every assumption you have made can be, in reality might turn out to be wrong. So in this simple model, just in the Gordon growth single stage model, an obvious assumption is that there is a certain growth rate. How many assumptions have you made? You made an assumption about beta, based on which you came up with R. You are making an assumption about the growth rate. You have made an assumption about the risk premium, based on which you came up with the R. So you've also made an assumption about what the risk-free rate will be in the future. So all we are saying is that you come up with a base value that you arrive at given your best assumption for all these numbers. Let's say that the value that you come up with is 80.48 for the value. Then in a sensitivity analysis, you take one variable at a time, such as beta. So if your base case estimate is 1, then keep everything else the same, but make beta 0.75. And you will get does it surprise you that this value is higher than the base case? When you use so this in the rectangle, when you use a beta of 0.75, the value goes up. Yeah, because beta, it's a safer stock. Lower beta means safer, and hence the present value will be higher. If you assume a high beta in this circle, then the value goes down. So you do the same with all the other variables. And just to check your understanding, our valuation is most sensitive to which variable? How do you figure that out? Actually, the point is this is a slightly tricky question. An analyst typically wants to see that his valuation is most sensitive to which variables. How do you do that? You look at by looking at the range. So you maybe for every variable you increase it up and down by say 2% or 1%, and then look at the variation in values. The reason that's hard to do it here is the different variables have been changed by different percentages. So it's hard to just look at these numbers. But now that you are somewhat, you are already fairly smart people, and now you know more, just without even looking at all these numbers, of all these variables, which variable do you think valuation will be most sensitive to? Yeah, probably most sensitive to the growth rates. Okay, but the formal way of doing it is to change every variable by 1% up and down and see where the range is the greatest. Okay, the next few items in this reading are fairly straightforward, but I still think there are a few critical items that are slightly new. The principle here is, when we did dividend discount models, do you remember doing 2-stage, 3-stage, etc.? So how did we use those models? All we said is we forecasted the dividends, and then using different models we came up with the present value. Is there anything stopping us from doing the same concept with free cash flow? So we do more or less the same thing. The key is to figure out what those free cash flows are. Okay, so let's see if you've learned what you've learned so far. With this company, given the numbers that you see over here, let's see if you can just calculate the free cash flow to equity for year 1. Because once you do that, then if you can do it for year 1, you can do it for year 2, you can do it for year 3, and you can find the present value. But the only thing new that we need to make sure you get from this segment is the ability to come up with free cash flow to equity. So do it.
For year 1?
Yeah, just for year 1. Just the free cash flow for year 1. I'm assuming that the rest you can do if you can calculate it for year 1. Yeah, the answer is 0.9. I'll just give you a couple more minutes and then we'll do this. Okay, something that you get used to when you do these problems, and here is an important term. When you look at net income and fixed capital net of depreciation, this net of depreciation means that depreciation has already been accounted for. So I'll help you do this very fast. So what was this is year 0. Sales growth rate is 20%. So now we are talking about, let's say, year 1. What will sales per share in year 1 will be 25 up by 20%. So that would be 30. The net profit margin is 10%. So that means what's your net income per share or earnings per share?
3.
So EPS is equal to 3. Okay, then you need to, normally what would we do? We would add depreciation, but since that depreciation we are giving, dealing with net investment in fixed capital, net of depreciation, that's already accounted for. So to this number, what do we need to do? We need to then look at what is our fixed capital investment per share. Is that added or subtracted? Subtracted. So what's our fixed capital investment? So 50% of sales. So that will be 2. So our fixed capital investment is 2.5. So fixed capital investment is 2.5. That's going to be subtracted. Our working capital investment based on the data given is 1. That's also subtracted. But then what are we being asked for? Free cash flow to equity. So do we also need to figure out what our net borrowing will be? Yes. So what is our net borrowing? It's 40% of this, 40% of 3.5, which is 1.4. Okay, so is that a plus or a minus? That's a plus because we are doing how much. It is net borrowing. The net borrowing is positive. So you put all these together and you get free cash flow to equity on a per share basis is 0.9. Okay, lots of little tricky things, where to deal with depreciation, where not to deal with depreciation. Again, practice all these examples and then practice the problems at the back. Now, obviously this problem asks you for total valuation, but I think you can do that. Why? Because you know the required rate of return. You now know at period 1, you know your free cash flow to equity is 0.9. The rest is just using the same procedure. You calculate this. Why is this called two-stage? Because for a certain number of years we'll have non-normal growth, and then after that, once we have steady growth, then we can use the Gordon growth model. Since you've done that a million times, I don't think there is any value doing that over here, but it is something that you will get on your exam, so make sure you are good. In fact, I've just cut-pasted over here. So if we look at all these numbers, why do you think there's this big jump in growth rate of free cash flow to equity over here? Yeah, actually what the reason is that from year 3 to 4, if you look, this is the time when the company stops growing too fast. When the company stops growing very fast, what happens to the working capital investment and the fixed capital investment? It suddenly comes down. So if those numbers come down a lot suddenly, what happens one-off to your free cash flow? It jumps up. But then after that, it goes up, but not in big jumps. So how will you value this company? This is period 1, so you'll take the present value of this, the present value of this, the present value of this, and then if you take this number, actually the simplest thing to do is just take the present value of this also, and then this with the Gordon growth model. Yeah, actually there are two ways of doing this. One way, which is stated in most finance textbooks, is what we are doing is just simply discounting, getting the present value of all these cash flows. So one way is what I'm describing right here, the present value of first 4 years. And then how do you come up with the present value of all subsequent years? So this would be, at this point, V4 will be equal to 3.7 divided by, the R is given earlier as, so 0.12 minus 0.06. This will be the value at the end of year 4, and then you discount this back.
Multiplying 3.7 by 1.06 as well?
No, since you have calculated, so since that is V5, that's the cash flow at time 5, you are coming up with the value 1 period earlier. Okay. If you are confused by this, just stay back. There are many ways. The core point is, what are we doing? We are coming up with the present value of future cash flows. Okay. If there are any issues with that, you just stay back and we can talk about it. All right. So let's move on. Example 19. Again, this is now a three-stage free cash flow valuation, and what we are doing here is the concept is similar. How will we do this three-stage? We are given all the necessary data. If we want to find the total value of the firm, how do you think we will do this? We are going to, using the sorts of assumptions we made earlier, we are going to project over time 0, 1, 2, etc. We'll figure out our free cash flow to firm for period 1, period 2, period 3, whatever they are, and discount it back. Now, in this particular reading, they don't talk about the H model and so on. But if you have a situation like this, where you have a growth rate, that this is the growth rate, this is time. If you have a growth rate like this of free cash flow, say 20%, then this comes down to 10%, and then it remains stable. Can you apply the H model? You can. But remember what I said in the discounted cash flow statement, that analysts will just use Excel. And that's what they've done in this particular problem. All they've done is they've assumed three different growth rates. So they've assumed for a few years we are at 8.8. Then we come down slowly from 8.8 to 6.4. And then we have steady growth of 3.2. Then they've assumed, we calculated free cash flow to firm at period 1. And then where are these numbers coming from? Based on growth. So in Excel, we probably just plugged in that growth rate and came up with these numbers. Then in Excel, we simply came up with the present value of all those numbers. Where did we come up with this 683? So here this 683, so this is another way of solving this problem, where value at time 7 is equal to this cash flow at time 8. So this was equal to 1283 divided by whatever will this be WACC, or this R means WACC? Okay, minus what would be the growth rate? Minus 3.2. So this 683 represents the present value of all these subsequent payments. Okay, actually, they've already figured out V7, and they have discounted that back. So this is material that you have seen multiple times before. If you can't get the answers that they have in the curriculum, then either speak to a friend or speak to me, because you need to be able to get the right answers. Okay, the final segment in this reading, how do we deal with non-operating assets and firm value? Okay, the idea here is very simple. What do we mean by non-operating assets? Non-operating assets would mean that a company that makes laptop computers, okay, let's say has two kinds of assets. One is operating assets. This is the plant, equipment, working capital, everything that is used to make laptops. In addition, it has some marketable securities. Okay, so money that is just invested somewhere. When we come up with free cash flow to firm, when we come up with the value of the firm, notice that when we have talked about that, we are really calling that, so this value of the firm, this is equal to the value of operating assets. How do you come up with the value of operating assets? The value of the operating assets is the present value of what? FCF2. Of the free cash flow to firm. So that is the present value of the free cash flow generated from the operating assets. That gives you the value of the operating assets. Let's say that the value of the operating assets is 100. Okay, then let's say marketable securities are worth 5 million. That's their fair value. So company has invested money in T-bills, in corporate bonds, in stocks, all marketable securities worth a total of 5 million. Those are non-operating assets because they have nothing to do with the regular operation of making laptops. So the value of non-operating assets is 5. Is that 5 part of the overall value of the firm? It is, because if you have $5 million sitting in your pocket, that makes you $5 million richer. Okay, so what's the total value of the firm? So that's the value of the firm, the sum of the value of operating assets plus the value of non-operating assets. Now, if I ask you what's the value of equity, Samir, how will you calculate that? So value of equity will be what? So it will be 105 plus what? It is 105 minus market value of debt. Okay, so fairly straightforward.
That will include the non-operating assets as well then, right?
Yeah. So the value of equity, so that extra 5 million belongs to the shareholders, right? So it includes that 5 million. So this is a very simple but a very important concept. Generally, in some textbooks, you might see the value of the firm equal to the present value of future cash flow. So if you see value of firm equal to present value of future of free cash flow to firm, is this right or wrong?
It might not have non-operating assets.
Yeah, exactly. This is an approximation, and generally the non-operating assets might be insignificant. So this is an approximation which might not be a bad approximation. As an analyst, you should see what are the non-operating assets. Do you think for a company like Microsoft, this would be a safe thing to do? Microsoft has huge marketable securities. So for a company like Microsoft, probably not a fair assumption. But for another company where it's a small percentage, then it's not a big deal. Okay, so that brings us to the end of this. Again, I want you to practice all the questions, even if they are not multiple choice, because it's critical, probably the most important reading in the exam. So make sure you do a lot of practice.